Good morning, everyone, and welcome to our DAT weekly market update. This is our update for October 3rd, 2023. I'm Ken Animo, Chief of Analytics over here at DAT, fresh off our bye week, nice and relaxed and recuperated. We've got Dean Croak, who's our Principal Industry Analyst, and we have a very special guest joining us this morning. We've got Peter Weiss from ITS. Good morning.
Good morning. Great to be here.
Live field reporting from the CSCMP show in Orlando, I understand. Is that correct?
That is right. Yeah. Crazy as ever. But a lot of great speakers, a lot of great tracks. Pleased to have been one of them.
Yeah, it's a great educational show. A professor of mine at Ohio State actually is the incoming, I don't know if it's chairperson or director, or whatever like that temporary position is for 2 years of the CSCMP, Terry Esper. So, yeah, those were always the more informational and kind of educational shows to go to when I was in the industry, and I always looked forward to those. So, Peter, for those not familiar, you want to give a quick background on what you've been up to and what interests you at the moment?
Sure. So I'm a supply chain guy through and through functionally. I've been a CIO for more years than I want to say. I've been at Fortune 500s. I've helped found startups. Was at a company called GT Nexus, which was one of the early cloud SaaS supply chain providers. CIO at Matson, led their digital transformation before that at APL Logistics, for those older folks who may know that company. Some startups in between that no one would ever heard of because they died on the vine. And I also did 5 years of teaching at my alma mater, UC Berkeley, sort of a class on the business skills that I wish I would have learned 25 years earlier in my career, teaching them to technology professionals. So I've done a little bit of everything. Retired, was a happy non-corporate guy, and was doing remodeling, being a dad, and advising, and some small-time investing in startups, and got lured back by this crazy company, ITS, which is both a billion-dollar company and a startup at the same time, leading their sort of transformation and growth as they plan to 5x over the next X number of years. And so lots of technology innovation work to do, getting their cloud TMS right, and also taking their technology to market, which I'll touch on in a little bit. So it's a great company, and it was good enough to lure me back into corporate life. And I'm absolutely loving it. It's unique culture.
That's great. We always say this, Dean and I always joke very endearingly, like ITS is a company that very few folks have heard of, but just like this absolute powerhouse in the space. Like it's, and it's almost like you guys like it that way, right? It's like, I don't know. I'm just always amazed at what's going on over there. And I know Dean came out and talked at your, at an event when he was out your way, and just hearing about that. And, you know, it's just a really cool story. And I look forward to talking to you in a few minutes when we bring you back from the market update to go into more detail. Does that sound good?
It sounds great.
All right, so we'll bring Peter back in a few. Let's get through our market update because I've got a bunch of questions for him, and I'm sure Dean and our listeners do as well. A lot going on, both at DAT and in the market. We're less than a week away from our big show next week at DATCon. The market, kind of as expected, right? So end of month, end of quarter to round out September, we saw a bit of a boost. I would not expect that to be very long-lived as things settle back down. And then we really start to think about what peak season is going to look like towards the end of this month, getting into November. Diesel is, again, also stuck right in that 460 a gallon range. And that just is continuing to put more and more pressure on the small carrier. And honestly, any carrier that's not on a fuel recapture program or runs any meaningful amount of spot freight, I think would be in that same bucket. Construction spending in August is up about 0.6% and up 7.4% year over year. Again, we've talked a lot on the show and had some guests talk a lot about the interesting split between single family and multifamily on the residential side, and then commercial, and how that's all shaking out. The ISM PMI at 49 in September is better than expected, but still the 11th month in contraction. Anything below 50 is contracting. Anything above 50 is expanding. The UAW strike enters its third week in earnest. We're starting to see more and more layoffs. Not seeing a ton of impact on freight. I suspect some of that is masked by end of month, end of quarter. I think we'll see the true impact of that in the coming weeks if it continues. But on the positive labor front, Mack Trucks did reach a tentative agreement with their union folks, which is promising. So with that, I'll turn it over to Dean to walk us through our market update.
Yeah, thanks, Ken. We'll have a sort of an abbreviated market update today. We'll start off with the load to truck ratio and dry van. The full long-form version of today's report will be up this evening, so we'll get through this pretty quickly. Load to truck ratio up to about 22% to 3.07. That's the fifth time the dry van load to truck ratio has been over 3 this year. But certainly end of month, end of quarter volume boost last week helped improve those numbers. The refrigerated load to truck ratio up also last week, still a fair bit lower than last month. Obviously, national produce volumes are declining. They were down 8% last week. That's affecting the national reefer market. Load to truck ratio was also up to 3.49. That's about half what it was this time last year. And in flatbed, load post volumes have been improving. 6 weeks of gains in that particular market. It's the first time the flatbed load to truck ratio has been over 8 since the end of June, ended last week at 8.08. Having a look at some of our major markets, we'll start in the Pacific Northwest in Portland. Capacity tight up there again last week. There was a 33% surge in load posts last week. So they've doubled in the last month. Line haul rates up 12 cents a mile, averaging about $1.23. That's excluding fuel. So you'd have to add fuel into that to get the all-in rate. A couple of lanes, Portland to Ontario, paying 71 cents a mile. Phoenix loads were paying just $1.19 a mile. But after dropping for the prior 3 weeks, spot rates for outbound loads in the large Ontario market adjacent to Los Angeles up 4 cents a mile last week to $1.84. Having a look on the East Coast in Georgia, large distribution market there, rates mostly flat at $1.56 a mile. That's 8 cents a mile lower than this time in 2019. In the refrigerated market, having a look at the southern border market, after dropping for the prior 3 weeks, outbound reefer rates in Laredo, that's the largest border crossing on the southern border, up 6 cents a mile last week to $1.62. That was boosted by a 32% week-over-week increase in load post volumes. In McAllen, in the Rio Grande Valley, load posts up 22% last week, but there was a surplus of capacity. Outbound rates were down 10 cents a mile last week to $1.61. Pacific Northwest, obviously fall produce season is influencing that market. In Pendleton, Oregon, rates up for the 4th week, and they'll pretty much do the same all the way through the end of the year. They averaged $1.93 last week, 2 cents a mile increase. In Twin Falls, Idaho, that's the second largest refrigerated spot market in the Pacific Northwest, rates down 8 cents a mile to $2.07. Midwest markets, Joliet and Chicago, averaging $2.38, down 15 cents a mile in the last 2 weeks, down 4 cents a mile last week. And in flatbed, having a look at the Pacific Northwest, capacity is tight up there most often, particularly in Medford and Portland. In the Pacific Northwest markets up there, rates average $2.52 in the region. In the last 2 weeks, load post volumes are up 32%. In Twin Falls, Idaho, that's the second largest flatbed spot market in the Pacific Northwest. Load posts are up for the last 5 weeks. Rates are averaging $1.52 per mile, up 6 cents a mile. And wrapping up our market update with our year-over-year look at spot rates, after dropping over the prior 3 weeks, dry van line haul spot rates bounced back last week to where they'd been over the last 2 months, around $1.60. Up 2 cents a mile last week, still 28 cents a mile lower than this time last year. And compared to our top 50 lanes, based on the volume of loads moved, they averaged $1.88. Our national average is 28 cents a mile lower. In refrigerated, at $1.94, reefer line haul spot rates are 28 cents a mile, also lower than this time last year, sitting about 8 cents a mile higher than 2019. Spot rates have dropped about 18 cents a mile since the July for produce season high. And lastly, in flatbed line haul rates regained the prior week's losses, up just a penny per mile last week to a national average of $1.92. That's also where they've been sitting for the last 2 months. And that's it for this week's market update. Remember, if you want to find out more about what's happening in freight, go to dat.com/market update this evening and download our long form version of the weekly report. Back to you, Ken, for the short-term forecast.
Thanks, Dean. So here's our short-term forecasts for this week. Remember, these are always excluding fuel, so they're line haul only. The blue line goes back a few months, so it's back to April 1st. It's the 7-day weighted moving average line haul only rate. We always start with dry van. And then there's 4 forecast model runs. We've got green, which is raycast. We've got red, which is a short-term model, which is really heavily weighting what's happening right now. And then you have a gray and a yellow, which are intermediate blends of the two to varying degrees and strengths. And what you can see is compared to last week, we're starting to get into some model disagreement. So it's kind of interesting what the difference a week can make. Raycasts is sort of feeding off of that seasonality that's starting to reemerge, that end of month, end of quarter. It's a little less pessimistic, and it's starting to pull out of that nosedive. The short-term model, for lack of a better term, doesn't really know any better, and it just continues down and to the right, which is, I think, extremely unlikely. But that model, again, is a short-term model. We keep it around because it does overreact, and it just doesn't really kind of know any better. Let's go to refrigerated, which is much more in alignment, at least for the first half of the forecast period. And then you see raycast starting to express that seasonality that we would see, as well as the other two models. And then the short term just isn't buying it. Especially, it's not really buying it until we start to get closer and closer to that first or second week of November, when it starts to tick back up. Flatbed is going to be the one with the most model agreement. It's just been pretty much the same story every week for the past few weeks, even the past few months. You see the short-term model is pretty much in alignment with one of the hybrid models, which has things coming up a little bit and then joining with the other two and bringing it back down into the right, coalescing on that $1.80 a mile, excluding fuel for flatbed. The thing is, construction, and especially things up in the north, tend to really slow down this time of year as weather starts to blow in, and you would expect it to slow down as seasonally expected. Unlike dry van and refrigerated, which have kind of two bookended peaks in the spring and in the fall, late fall, the flatbed peaks more in the summer and has kind of a calmer bookended tails to start and end the year. So that's what you're seeing in those models. All right, we're going to bring Peter back for our question of the week.
Yeah, thanks, Ken. So, Peter, what's the market saying about data trends in general and the role that data plays on the journey to more autonomous supply chains?
Yeah, that's a great question. And let me give a little bit of context. I've been in this space a while, and there's always been this historical issue around pure software providers versus 3PL solutions in terms of solving BCO and shipper supply chain visibility and data issues. It goes all the way back to my days at GT Nexus over 20 years ago. And think back, originally, who had the advantage? It was the 3PLs who had the advantage. They were the early movers. They had the business knowledge. They had the customer relationships, and they had enough IT capabilities to put some solutions out there to keep the early software players at bay. But the world has really changed, and there's this collision course going on right now based on data and software, which combined to make the platform. But I would say the bigger issue is data. So there's these pure software companies that are now coming into the market pursuing visibility, and they're shiny and they're great marketers, and they've won a lot of deals and they've made some splashes and have taken away some business from traditional 3PLs who have focused too much on operations and not enough on innovations. So there's those software players, and then there's kind of, I'd call the tech forward 3PLs, who are also terrific at customer facing, market facing software, but they can't get their back end data right. And so this is created because they have struggled and had layoffs, and some of their struggles are well known in the marketplace. That leaves sort of traditional 3PLs with another opportunity to get their data right, to innovate more, and either adopt to the innovation needs of their customers or shrink their way to oblivion. And so what I'm seeing now is that after this initial splash, if it's not a backlash, it's a dose of very healthy skepticism that the flashy tech forward 3PLs or the pure software providers know this industry well enough, the nuances, the painful steps to move a drayage container or an international container, and to move it right, and to have the right alerts, and to know within hours every single thing that happens. And so, that parable, the chicken and the pig, when you make breakfast, the chicken is involved, but the pig is committed. The software companies are kind of the chicken. They can win a deal, they cannot win a deal, they can win a deal, provide poor data quality, but they got a multi-year deal, so there's little short-term impact to their data failures. Whereas if you look at the 3PLs, we have to have our data right, because guess what? We run our business on this data. So it's not just about losing one deal if we don't get this data right. We just have to get it right, or we can't be a successful growing company, which we are. So I think the high-flying tech forward 3PLs and the software companies are now colliding in a new and dynamic way, and it's all because of data. And we believe that 3PLs who can focus on innovation are the ones that are going to win over software companies for the most part. Certainly will fare better than those who either are pure software or have a great market-facing product but don't have the right processes on the back end, if that makes sense, to keep the data timely, accurate, and complete, which is how you define enterprise-level data quality.
Yeah, the thing I wonder, before we even get into the data aspect, is I wonder how the risk-reward calculus is being done at these tech brokerages, right? Like, almost universally panned when these marketing announcements go out. It's as if they've invented trailer pooling, right? Like, we've got dynamic trailer capacity for the first time in history. It's like, well, firms have been doing trailer pooling as long as there's been trailers, right? Like, I don't know if you have any insight on why they've seemingly self-ostracized themselves from the rest of the industry by kind of the condescending nature of, almost universally, the condescending nature of the marketing.
Yeah, so I've been in software long enough. So, I'm a technology guy. My functional area is supply chain. This story is as old as time. Go back to companies like i2 and Manugistics and Oracle and all of the early movers who create a FOMO situation where, trust me, we are so darn smart that you should follow us. I can't explain why, because it's too complicated for you, but we're right. So come along. And i2 is a great example. If you remember their stock 20 years ago, I don't know, went up to several $1 billion before it went down to a penny stock and got acquired, as did Manugistics. They were in the supply chain planning space more than execution. But this is a classic software story. And these companies have, I think, and you can read as public knowledge, have overspent on tech, not always wisely, hired a lot of tech people thinking that pure tech will solve the problem. And the truth is, the magical moments happen when you have business savvy people combined with who are equally respected as the tech people trying to build this out. And so they're tone deaf when they go to markets, and maybe they win some people over and then they lose them over time. And I think that's an arc that I don't know how long that arc is, but that's the arc that we are bending towards in my view. So these tech companies better get some real experienced on the ground operations people, or they're going to be in big trouble. A lot of investors are going to lose a lot of money.
Yeah. I mean, just like golf, right? Golf's a sport. No matter how good you get at it, it'll humble you, right? It'll sneak up on you on Sunday and it'll just humble you on a random Friday, right? Where you think you've got it all figured out. Yes. I found that with logistics, right? I haven't spent nearly as much time as you have, Peter, in the space, but I'm over a decade in at this point, and I just found that anytime you think you have it figured out, and you get too far over your skis, you're due to be brought very harshly back down to earth. And I think it's that resilience that the firms that have stood the test of time and have continued to grow, that's kind of a trait that I've observed through all of them, is the sense of resilience and the sense of humbleness, that they're doing good, but they might not have it all figured out, and they never probably will. And that seems to be core of what ITS is sort of all about, right?
It really is. We have this magical mix of industry veterans who have seen everything. We went through the near-death experience of 2809, 2010, the boom of the 90s, the boom, around COVID, the bust around COVID. And so when you've been through it, you know what it takes and what could be next and how you need to plan your technology, your processes, your staffing, your customer messaging. You have to get all of this right. And it's true. Andy Grove, the old CIO from Intel, those who remember him, said only the paranoid survive. And there's just no room for hubris. This is not about selling a big software deal. This is about taking care of the world and the movement of freight around the world. So no question. The people who understand those, who have seen those arcs, they've seen the arcs, so they know what can happen next, which we're already talking about. in our company.
Yeah, our CFO is a disciple of Andy Grove. I hear costs are certain, everything else is a forecast, probably 2 times a week.
That's
Right.
a good one. I like that.
That is a
too.
good one. So I think the question, we've had management consultants come through our doors seeking to understand the answer to this. We think about it a lot, right? You sit back in your chair and you bounce the racquetball off the wall. If you had to place chips on the table, would you say that, it's going to be an established player in the industry that figures out kind of the digital brokerage at scale first, or do you think it'll be one of the disruptors, a la Uber Freight or LoadSmart or one like that? Like, where would you place your chips?
I think it would be on one of the big established players or a medium-sized established player. How about that? And I say that, think about the cloud and think about, do you remember what people said about Microsoft and the cloud, or what they said about Microsoft's OS that before they had Windows, and then they'll never get cloud right. Look who's one of the most profitable, valuable companies in the world. It's Microsoft. They had a fantastic customer base. They had to make some leadership changes. They got their messaging right. They made their investments right, and they had deep enough pockets, a profitable customer base, a good balance sheet, and they brought in smart people, and it took time, and this will take time too. This won't be solved in a month or 3 months or 6 months. It could be some time, and this is an evolutionary issue more than revolutionary. And so the companies that have solid bases of business, solid customers, and smart innovators are the ones who are going to solve it. So I think it's going to be one or more of the mid to larger size traditional companies, and I would put us in that mix. We are focusing heavily on innovation now that we have our core cloud-based TMS right. So we're going on offense in terms of innovation as well.
That's a fantastic analogy, right? I mean, I was kind of coming up when the cloud battles were being fought, and like Azure was a distant third besides GCP and AWS, almost laughably third.
Yes.
And now,
Who's third now? Google, right? The B2C company is the one that is third, and the traditional strong B2B company, the two B2B companies, are winning, and Azure is gaining on AWS. We're in fact an Azure shop. My background is AWS in previous lives. In fact, I've spoken at the AWS tech conferences, and lo and behold, here I am, a convert to Azure. Everything that AWS has and more in some areas. But it took them a long time to get there, but they got there. Great people.
I think the partnership with the generative AI platforms is going to probably push them to number one, to be quite honest with you, because that's an area I see AWS lagging behind Azure, is partnering with companies like OpenAI and others to really drive the ball down the field, pardon the football reference, on generative AI.
Yeah, that's our bet as well. We're looking at other solutions, but most of our tools now are on the Azure platform, and that includes what we're doing in AI.
Anything from you, Dean? I'm kind of monopolizing this kind of geek out here.
Yeah, I'm happy to take a back seat, but I did have a question for Peter. You mentioned at the start of the show about some of the problems that competitors face around data quality, data structure. Can you speak a bit more about what specifically it is about data that becomes a limiting factor?
Yes. So, and again, when I say data, that would include the software that moves it around. Every time data moves, it can leak if you're not great at integration. So everything starts with the foundation, inside out, getting your TMS right, modeling the data, architecting it, how you capture it, how you store it, how you govern it. None of that work is sexy. Nobody sees it. No customers see that work until you try to send them data, right, or receive their data, or present or render their data on a website. So right, the heavy lifting, the unsexy work that nobody sees is the work that every great 3PL, any great organization needs to do. And of course, it needs to be in the cloud. There are some decent 3PL packages out there for TMSs. We think software development's a core competency for us. So we have the organizational muscle to build it ourselves. So it all starts with doing that heavy lifting. That is not sexy. You don't do a press release because you've got your data model right. You don't have customers singing your praises about how amazing your APIs are. That just doesn't happen. But that's the inside out approach that any great company that wants sustainable excellence needs to pursue. And that's what we've done. And companies who have skipped straight ahead to the market facing stuff to make a splash, to get a press release, to win a deal, they're going to pay the price down the road. You have to get the data, what I would call fast, up and safe. Fast, up and safe. That is a mantra within our company. Everything we build has to be enterprise class. It means you need data architects, data scientists, a lot of expensive hires that many companies don't want to invest in because they don't see the immediate ROI payback.
Right.
But it's the long-term steps that you have to take so that everything you render to customers and partners or receive from them, maps in beautifully and seamlessly. So you can achieve operational excellence. Yeah.
Peter, one of the questions that we sort of started the show with, or your segment with, was about autonomous supply chains. Can you speak a bit more to what that means? What aspects of the supply chain are you talking about?
Yeah, so I see this as an arc too. My answers might sound a little redundant, but there's sort of 3 stages to get to autonomous steps in the supply chain. First of all, there's kind of digital. You have to have your data right, all the things we were just talking about, so that you trust that data with your company's life. The next sort of step in the arc is intelligent. So if you've got all of your data right, you can then apply data scientists to go through the data and to optimize your supply chain. So you trust your supply chain to operate, you optimize it by making the right decisions through data science and analytics. And lastly becomes, you can then go autonomous, where you can, and it's I don't know that it's ever going to be 100%, but there will be a number of steps in the supply chain that can then become autonomous if you've studied the data based on data you can trust. So the autonomous supply chain starts in the planning phase. It could be anything from looking at last year and automatically placing purchase orders for products based on demand and supply. It can be automating transportation, how you allocate your shipments to your carriers. It could be automated replenishment because you got surprised by a heavy run on a particular product that automatically places an order without delay so that you can replenish and reduce the odds of out of stock. And so anywhere from, and there can be auto payments as well. So any step in the supply chain, from planning, which comes right before supply chain execution, all the way through the time the order is placed to fulfillment and payment, any of those steps along the way can be automated depending on your culture and depending on how much you trust the data and how much you got steps 1 and 2 right. So will it ever be 100% autonomous? No. Right. So the analogy of a car roughly holds, but I don't know that it matters whether you're 30% autonomous or 70% autonomous. Think about all the knowledge you're wasting on routine tasks, and the companies that are more autonomous will take more smart people out of routine tasks and put them on more high value work. And that's going to make them better and faster and more profitable. So think of digital to intelligent to autonomous. That's the journey, all based on data. Hell yes.
Got it.
Love it. So maybe to round out on one last tech question, I think it's front of mind for a lot of folks. I think truckload transportation, and specifically on the 3PL side, is very unstructured, right? And we all see the generative AI wave coming and its applications with unstructured data and solving those kinds of problems. What's your outlook for the impact of generative AI over the next, let's say, 1 to 3 years? Is it more of a fad and a clickbait, or is it actually going to have a profound impact on what these businesses are doing in the next 1 to 3 years?
You're talking about in truckload in particular?
Truckload mainly. I mean, you could focus it on 3PL, but I'm thinking more broadly in truckload as a whole.
Yeah, I think it's going to follow the Gartner hype curve, right? If you're familiar with that, how you move up and then you go down into doom and then you rise back up. Almost anything in the supply chain involving technology goes on that curve. And the reason is there are so many partners and players involved. For example, with truckers, if you had the world's greatest idea, we deal with tens of thousands of truckers. We do have an app for truckers to try to push more things faster to them. The adoption will always lag. And so I expect this to be more evolutionary than revolutionary. I don't think generative AI is a disappointment. I don't think it's a fad, but I think it will follow the curve of many, many other sort of very worthwhile, first underwhelming, and then quite valuable technologies, that have occurred in the supply chain in the past. So I think what you'll see is the ability to build it out as usually, will outstrip the industry's ability to adopt it productively. But we're still going to do it. We're just not going to burn a ton of money building out stuff that the market is not ready for. So markets will tell you how fast this will go. And so great product teams, great engineering teams, great leaders listen to markets. Markets will tell you what they're ready for. You just got to have great relationships to listen. So our approach is going to be incremental in building out tools and experimenting. We've launched our first product that's in the DAT space that has some pretty cool AI built into it. And we've rolled it out to a handful of customers. We're selling it on a limited basis now. And before we go too far, we're going to hear what customers have to say about it. So far, we like what they say. We think we know what we want to build next. But if you do this right, if you have the foundation right, if you've got the Azure tools right, if you've got the talent, you have to be nimble. Right. So I think it's more evolution than revolution, but it's here to stay, for sure.
Yeah, I like that. I mean, I think I'm battling, at least on my front, kind of the teeter-totter between distraction and productivity, right? Like everyone wants to do it. Well, I guess it's like if you could bend time and had a teeter-totter that went in three directions, and then there's the governance aspect, someone dumping all of our data out into a public GPT and then kind of getting into some big trouble, or copyright and trademark infringement and all of that. So it's an interesting time to be a leader in the space.
Yeah, it really is. It really is. So we'll be cautious and incremental and keep our ear to the ground.
All right. I'm going to end it with one freight question, actually germane to moving freight. So this one's for you, Dean. Regarding the reefer market, how much is the reduction out of Central California from crop losses because of Hurricane Hillary? Grape crop loss. Hope it doesn't impact wine production. Grape crop loss is equivalent to 13,000 loads.
Yeah, it's going to have an impact, I think, by the end of the grape season, which is, of course, we're almost at peak harvest time now. The Hurricane Hillary wiped out about 25 million boxes. Volumes out of California are the lowest in 7 years. I looked at the grape volume last week on the USDA website, down 9% year over year as of last week. That's not a huge number in terms of truckloads, John. It's about 156 fewer loads last week. The reason why it's not moving the needle right at the moment is you're seeing much higher volumes of, celery, lettuce, strawberries, broccoli. Those sorts of things are still coming out of California. So yes, it'll have an impact by the end of the year. At the moment, not so much at a product level, but year over year, California volumes are sitting at around, I think the number is about 9% lower year over year.
All right. Great answer to that question. All right. You want to move to plugs, Dean?
Yeah, a few quick plugs. Sales chatter tomorrow. We've got a great guest. Jim Blaze, railroad economist, is on 11 a.m. Eastern. Peter's at CSCMP this week in Florida. We've got our own Chris Kaplis there talking to Steve Rates from C.H. Robinson. He's also our next guest on the Freight Vine podcast, talking about the uncertainty in transportation. Dr. Inam Ayub is there today talking to Rajib Sakar from Colgate Palmolive, talking about truckload capacity movements. Don't forget, Canadian Thanksgiving is next Monday, October the 9th. We've got DATCon next week, October 10 to 12 in Houston. And because we're all at DATCon, we won't have a show next week, but we'll be back on October the 17th. Our guest then is Andy Milton from Mansfield Energy, talking about diesel prices and global oil markets. Back to you, Ken.
All right, Peter. If folks want to work, haul, or ship with ITS, how can they get in touch with you?
Well, they can reach us through our website. Patrick, where else? Who should we reach out to?
Social media.
Yeah, all the social media channels. We're pretty active there. We have a terrific head of marketing. His name is Patrick McFarland. If you haven't met him yet,
He's the man.
He's about 4 feet to my right. So we made a lot of great contacts here, and we're open. We're not hard to reach. From the CIO to the COO, the CEO, we're not so big. We respond when people want to reach us.
I love it. Awesome guest. I really appreciate you taking the time out of your busy schedule down there at CSMP to join us. So thank you for that. I'm going to wrap us up. Like Dean said, it's all hands on deck next week. We're going to head to Houston. It's going to be a great event. We've got 2 huge product releases we'll be talking about. So stay tuned for more information on that. I think it's going to be really exciting for those who use our tools every day to see the use of AI. It's supposed to be great weather week in Houston. We'll have a record number of attendees, so it should be a super fun event. And with that, we're going to sign off. We hope to see you there, and we'll see you in a couple weeks. If not, talk to you later. Bye.
Thank you. Thanks, Peter.
Through the course of these next 2 days, there's no better chance for us to get your input and answer your questions in one really great collaborative event.
We have so much innovation going on and so much investment, so I can't wait to share this. This is exciting. We're using AI and machine learning and intelligence so you get action right away.
It's about bringing together all aspects of the network to solve your problems.
And we know that you all move faster if we provide that connected experiences for you.
We are trying to make it easier for you to use our products. It's going to continue in 23, and this is a testament to that. With 2 million trucks in our app, all of the stuff in the network, all of the knowledge in this room, we can legitimately change this industry.